When short squeezes fail, identifying false signals and avoiding traps. The siren song of the failed squeeze. Initial excitement. Why do traders jump into obvious short squeeze plays? Short squeezes promise something every trader secretly craves: fast, explosive profits with minimal waiting. A ticker flashes across social media with triple digit short interest, and suddenly it feels like a once in a lifetime opportunity. The psychology is powerful: fear of missing out, FOMO, memories of legendary squeezes, GME, AMC, VW, the belief that retail is finally beating Wall Street. This emotional cocktail overrides discipline. Traders stop asking whether a squeeze will happen and start assuming it must. That assumption is where most losses begin. The classic setup: high short interest, low float, and a catalyst. Most squeeze narratives follow a familiar script: high short interest above 30 to 40%, a relatively small float, and a catalyst such as earnings, FDA news, a partnership, or a restructuring announcement. On paper, this looks airtight. Shorts are crowded, supply is limited, and something positive could force covering. But here's the uncomfortable truth: these conditions are necessary for a squeeze, but they are far from sufficient. High short interest often exists because a company is fundamentally weak. Shorts aren't villains by default. Many are sophisticated analysts betting on real problems. Early warning signs when the perfect setup is a mirage. Some red flags appear long before price collapses. The company has a long history of dilution, cash burn is accelerating, management avoids clear guidance, and prior catalysts never led to sustained moves. If the stock has attempted multiple squeezes in the past and failed each time, odds are high that this one won't be different. A stock that cries squeeze every quarter usually becomes background noise, not a breakout. Anatomy of a deception. Technical mirages, bullish patterns that trap traders. Certain chart patterns are frequently misread as short squeeze confirmations: bull flags, ascending triangles, cup and handle formations. In legitimate breakouts, these patterns form after accumulation by strong hands. In fake squeezes, they form during distribution. Price grinds up slowly, giving the illusion of strength, while large players quietly sell into every pop. When support finally breaks, liquidity vanishes. The chart didn't fail, it was never bullish to begin with. The pump and dump connection. Many failed squeezes resemble classic pump and dumps. A cheap stock with high short interest is selected. Influencers and forums flood timelines with bullish narratives. Price spikes on retail buying. Early promoters exit. Price collapses. The key difference: the word squeeze provides plausible deniability. When it fails, promoters claim shorts manipulated it. In reality, retail was the exit liquidity. Whale games: how institutions exploit short squeeze hype. Large funds and market makers understand retail psychology extremely well. They may allow price to run just enough to trigger FOMO, sell call options aggressively, hedge positions in ways that benefit from volatility rather than direction. They don't need a squeeze to happen. They only need traders to believe one is coming. False signals dissected. Volume divergence, when big volume is actually bearish. High volume is often celebrated as confirmation, but context matters. Rising price, falling volume equals weak demand. Flat price, huge volume equals heavy churn. Spikes on red candles equals distribution. In many failed squeezes, volume surges while price barely moves. That's not pressure building, that's supply absorbing demand. True squeezes show expanding volume with expanding range. The news trap. Not all catalysts are equal. Be cautious of vague press releases, non binding strategic partnerships, and old news reframed as new news. If news lacks clear financial impact, revenue, margins, cash flow, guidance, it may exist solely to justify a promotional push. Real catalysts change the business. fake catalysts change sentiment temporarily. Social media echo chambers. When every post says the same thing using the same phrases, shorts are trapped, gamma squeeze incoming, burrow rate exploding, you're not witnessing organic discovery. You're watching message coordination. Diverse, nuanced discussion usually signals genuine interest. Uniform hype signals a campaign. Avoiding the fallout. Risk management reboot. Short squeeze plays demand different rules: smaller position sizes, hard stop losses, not mental ones, and predefined exit plans. If a single failed squeeze can blow up your account, your strategy's broken. Survival beats heroics. The why test. Before entering, ask, why does this stock deserve to go higher? Who benefits if retail buys here? Would I like this trade without the word squeeze? If the thesis collapses without the squeeze narrative, it isn't a thesis, it's a hope. Patience is profit. Many traders lose money trying to catch the first spike. Professionals wait for breakout and hold, higher low, and follow through volume. Yes, you miss the first 10 to 20%, you drastically increase odds of keeping the next 50%. Future proofing your portfolio. Post mortem analysis. After every failed squeeze, review entry reason, confirmation signals, emotional state, exit execution. Patterns will emerge. Most traders don't fail because of bad markets, they fail because they repeat the same mistakes. A squeeze avoidance checklist. Before entering, is short interest verified from reliable data? Has dilution occurred recently? Does the company have improving fundamentals? Volume expanding with price? Is discussion organic or copy paste hype? If two or more answers look bad, walk away. The long game. Short squeezes are lottery tickets. Trading is a business. Sustainable wealth is built through edge, process, risk control, and patience. The best traders aren't chasing explosions, they're stacking probabilities. Bottom line, most short squeezes don't fail because the market is unfair. They fail because the setup was never real. Your edge isn't finding the next squeeze. Your edge is knowing when to ignore one.